Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. In this week's edition, we're actually going to be talking about how to spot manipulation in the Forex markets, okay? So, if you've been trading for any length of time or if you're just getting started with Forex trading, I'm pretty sure you must have heard traders saying things like, my stop loss got haunted, or I got swept in by liquidity, or things like that. Okay, and this is not things that traders just say that just sound like conspiracy theories and they don't have basis to them. Actually, it's far from that. There's kind of a bit of truth to it. And when I explain the logic for you today, you'll actually see the truth behind this. Okay? So, anyways, without wasting any more of your precious time, let's dive right into today's lectures, okay? So, the thing is, unlike small retail traders like you and I, when institutions trade, they're actually trading with a lot of volume. Okay, so it's not uncommon to see institutions or hedge funds or all of those, large corporations or even central banks, because sometimes when the central banks intervene in the market, you'd know they intervened by the large candles you'd see because of the influx of volume, okay, tradable volume of whatever instrument they were backing that you'd see. In fact, this happens quite a lot with the Japanese yen. So, because they are an export first country, you'd notice that when their currency gets more expensive against other currency pairs, counterparties, it's not good for their export because their things are going to start getting expensive. The cars they export, Toyota, all of those things, okay? And so in the grand scheme of things, that is not actually a good thing for them. And so there are times when their currency gets too expensive in the market, they intervene to sell lots of it, and that's their attempt to kind of push the prices down so that it will help to boost their exports, okay, by making their goods cheaper. So, what does this have to do with anything? This is just one example I gave you of a central bank intervening in the market, but it's not only central banks that intervene in the market. There are times when you'd see large hedge funds, large multinational companies, and all of that, because they have a genuine need to participate in the forex markets. Okay, for whatever reason they have, those kind of orders that they will take in the market are so huge that it's not just like you and I. For you and I, it's not uncommon for us to, when we want to get into the market with a trade, we just, place the trade with maybe relative to the account that we're trading. Okay, so maybe you're trading at most maybe a couple $100,000. This is if you're even trading, a couple 100,000. That could be the case if you're trading with prop firms or whatever. But if you're trading your own capital, you'd rarely find a retail trader who is trading capital which is in the millions of dollars. Okay, but these guys that we're talking about, they're actually trading hundreds of millions of dollars or even billions in some cases. Okay, now the thing is, when you're trading such huge capital, okay, whenever you try to get into the market with your trading position, you're going to get issues with liquidity. Basically, what liquidity means is, let's put it this way. Let's say you sell shoes, okay? Let's say you sell shoes and you found out that in the locality that you are, let's say you're not using any physical stores or, any online stores. You're just selling, whatever shoes you're selling in a physical location. You have a spot in the market and people come to the market to buy whatever you're selling and other things, and then they buy shoes. Now, let's assume that Nike just dropped one of the new, shoes that they do, and all of those shoe enthusiasts, they want to come and buy it from you. And so you rush to secure your hands on, a couple of the new shoes and whatever the case might be. Now, let's put it this way. Let's say in the entire city you're living in, and this is making the assumption that you are only doing business with people that come to your shop physically. Okay, so your business is limited by the physical location you're in. Okay, so let's assume that when that shoe gets launched, you buy, let's say, you secure a couple of pairs. Let's say you secure 50 pairs. But it so happens that in the locality that you are, the enthusiasts of that shoe, and not just enthusiasts who really like the shoe and who know the value of the shoe, but the people who can actually afford that shoe are only, let's say, 20 people. So now you've bought an inventory of like 50 shoes and you can only sell 20 because it's only 20 people in your locality that are interested in buying that shoe, okay? That know the value of that particular shoe. Now, in this case, if you used, obviously, you're going to use your money to buy the shoes, to buy the inventory, okay, to stock up. Now, let's say you used, just an example, $10,000 or to buy those shoes. This is just an example, okay? To buy the 50 pairs that you bought for your business. And now, after buying that amount, it so happens that when you sell those 20 pairs to the people who walk into your shop to buy it, you're left with those 30 pairs that people haven't bought yet. So let's assume that the 20 pairs that you sold them, with a profit and whatever the case might be, you got like, $4,000 back. But now you have 30 pairs of shoes that nobody is interested in buying. And so you want to get your $6,000 back because you invested $10,000 to buy those 50 shoes, okay? But then, because now there are not people that are interested in buying that 30 pairs that is left, what the market will refer to, if we're using the market terms here, is that it's very illiquid for you to, liquidate those shoes, to turn them into money. That's just what I want to talk. That's just what I mean, okay? So for you to be able to easily sell something and turn it back into cash, that's what liquidity is. Now, if you had more demand than supply, so there were lots of people who wanted to buy that shoe, let's say like 100 people, and you had only 50 pairs. In fact, not only are you going to be able to sell those pairs, but you might even sell them at a very high markup because the demand exceeds the supply. But when supply exceeds demand, most cases, you're going to find it very hard to liquidate that asset. Okay? So how does this impact the Forex market? Now, let's assume an institution wants to buy a couple $billion worth of the United States dollar against the Japanese yen or against the European dollar, the euro or whatever the case might be. Okay? In this case, if it was just you and I trading maybe a couple $100,000 or a couple $1,000 or at most, a couple millions, for us to just place a trade, remember the Forex market its daily turnover is in the trillions, okay? So for us to just place an order with that kind of account, it's nothing. You just place a trade. It's very liquid for that kind of transaction. So you'd be in and out of the market as if you are not even there. But for these institutions, because they trade such large volumes, it's going to be very difficult for their orders to get executed. And so what usually happens is these institutions, because it's difficult for them to get people to take the other side of their trade. Remember, if you are selling in the Forex market, you need somebody to buy from, okay, for you to do that transaction. So they need people to take the other side of their order. And what usually happens is that when you place a trade, a typical retail trader, let's say, for example, you identify that this area is resistance, okay? And so as you realize that this area is resistance, as a typical retail trader, most traders will be like, okay, price got rejected around here in the past. And so when price returned to this level, okay, trying to break above it and it failed, now you saw the formation of this, candles and all of that. You might be, tempted to say, okay, you know what? Since price is finding it difficult to break above this level, and obviously price has went from forming the market structure of higher highs and higher lows to now struggling to break above the high. And now price has broken below the higher low, okay? And then now it's testing this resistance. So when you would have seen something like this and you know that this was the previous resistance that price is struggling to break, a typical retail trader that is trading support and resistance is going to be like, okay, you know what? We have a bearish engulfing candlestick form here. We have another one form here. So I might just take a trade here, a bearish trade, a sell trade, and then my stop loss is going to be here above this resistance. Because for whatever reason, the logic is that if for whatever reason price is able to break above this resistance, then it's going to be difficult. It's highly likely that price is going to continue to the upside. That's the reasoning of a typical retail trader. Now, the thing is, let's assume that it so happens that when you finish your analysis, you saw the market structure shift, you saw price struggling to break above resistance and all of this, and the bearish engulfing candlesticks form, and all of these pointers that you saw, okay? And you decided to take a short trade. But let's say that not only you, let's assume that a very huge institution or a central bank or whatever the case might be are interested in also shorting this particular currency pair, going short on it so that price goes down, okay? The thing is, you have the luxury of just placing that trade and placing your stop loss. And if you place a sell trade here, your stop loss is going to be a buy order above this area. Now, you can just click on the button and just get into the trade because you're trading relatively to the size of the market, a small amount of capital. But for those other traders who are likely going to be trading in the billions or hundreds of millions or whatever, for them to just place this order is going to be a bit difficult. So they are going to have liquidity issues. And so when this happens, most of the times, they would need to kind of prep price up a little bit so that it will trigger the stop loss of traders who shorted, the retail traders who shorted prematurely. And so because when they push the prices up, your order that you sold here is going to be, your stop loss is going to be a buy that will trigger here. So by that buy, they will get the opportunity to sell that currency pair, because as you are buying to get out of your sell trade, when your stop loss is being triggered, they are the ones who are selling, because that's how they get the liquidity, okay? So as this is happening, then their orders are usually going to get filled. And then when they get filled, the real move is now going to begin. And this is what is meant by manipulation, okay? This is what is meant by manipulation. In a nutshell, these traders, these institutions, these hedge funds, these big multinationals, when they want to enter a trade, because of the sheer amount of volume that they are dealing with, most of the times they cannot just snap their fingers and get into the market like you and I would, by simply just typing in a couple lots or doing our lot size calculations and just pressing buy or sell, and then the order just gets through. Most of the time, they would find it extremely difficult to get into the market with these positions. And so they need to prep prices up and trigger the stop losses of traders, retail traders that took the trade early. And then when those trades get triggered, their own orders will now be filled, and then the real move will begin. This is what manipulation is. And this is what it looks like in the Forex space. Okay? So like I just explained to you, this is a typical example of manipulation in the market. When I take off my drawings here, you can see that this area served kind of like resistance. And so most traders would have shorted, after price was finding it difficult to break above this area. But then let's say huge smart money wanted to get involved in this particular trade. Most of the times they would try to prep prices up, and then the traders that sold somewhere around here with the stop losses around here, most of the time they are going to get liquidated around here, and then the smart money is going to join the move when the real move begins. Okay? Now, this is an example of a short scenario. And that means we had resistance on the market, and then now prices were, hunted to the upside. What would that look like if we had kind of like the opposite scenario? Now, look at what we had here. Okay? So price was kind of struggling to break below this support level. Or let me just draw it this way, okay? So this is kind of like support. And before it was support, it was actually resistance. And when you remember what we talk about in Technical Analysis 101, you notice that when support areas get broken, they turn into resistance areas. And when resistance gets broken, it turns into support. Okay? So let's say this is serving as our support area, because previously it was serving as resistance. Price was struggling to break above this level. And then all of a sudden, it gathered enough momentum to break above the area, retest it, and now the area is serving as support, and then price moved higher. So it continued forming higher highs and higher lows, okay? Now, what does this have to do with anything? Well, I want you to pay attention to the fact that price found resistance around here. Remember, we talked about this, okay? And why did we say that price found resistance here? Is because price tried to break above this level, and it failed. Now, what most traders would see is that price was forming higher highs and higher lows, but then all of a sudden it was struggling to continue forming higher highs and higher lows. So it got rejected somewhere around here. Now, price now formed a lower low. So the idea would be price formed a lower low and it broke below this support area. And so some retail traders might just rush into the market after the formation of this big bearish engulfing candlestick and say, you know what, price broke below this support, and so it's likely going to continue moving down. But this might just have been a manipulation, a fake out. Why? Because you can see that after this price broke below this level, it struggled to break below it, keep moving down, and then this inverted hammer candlestick got formed, and then we had the formation of this strong bearish engulfing. So the assumption here might have been, you would have thought that, okay, price broke below this level and it's likely going to continue moving down. But then let's say smart money has a lot of buy orders around here, and so they would have triggered your stop loss when you would have taken this trade, assuming that it was going to move down by this up move, and then that would have served as liquidity for them while they pushed prices up before this whole liquidity sweep got formed. Okay, so this is how manipulation manifests itself in the market. Most of the times, this does not mean that any slight move you see on the chart is manipulation, but more often than not, this is what it looks like. Now, what does this have to do with anything? This, you can use it in a way that will give you an advantage over the market. So the idea here is that there's a trade-off. There are traders who would say that, okay, you know what? If we find resistance on a price chart, instead of me just shorting when price comes to that resistance area and just, placing my stop loss above the resistance area, some traders would rather wait for the manipulation to first happen. And so when price breaks above a resistance area, they will not just buy or sell. They would wait to see that, okay, is this break a true break or is it a fake out? If it is a true break, then likely price is going to go up, pull back, and then get from the price rejection candlesticks here, and then price will continue moving up to keep forming higher highs and higher lows. But if that doesn't happen, and then immediately after price breaks out of the level, it now still breaks below it to continue moving to the downside, that is an obvious fake out. And so these traders will be like, I'm not going to short here at resistance. I'm not going to short here at resistance. And then when price breaks above this level and it fails to continue moving up, I know this is manipulation. So I'm going to get in when the big money is getting in, because they are the ones who cause the movement in price action. And so when you see this fake out happen and you see this bearish engulfing happen and price is struggling to break above this level, you take the trade. Your stop loss will now be above the level that was, the liquidity got rocked and whatever. And then you would have joined the big move. The same thing here. Price was looking like, okay, it was going to continue moving down because it now started forming lower lows and lower highs. But then when price broke below this level, the typical liquidity trader who knows about manipulation is not just going to rush into the market with a sell trade. He would wait. If this is truly a sell trade that, price broke below support and this is truly a break that is a clean break, it's not just a whipsaw or a fake out, then price is going to go down, come back up a little bit, get rejection candlesticks get formed at this previous resistance support level, which turned into resistance, and then now he's going to join the trend because he knows that when he gets price rejection signs around here, price is likely going to continue forming that lower low and lower high movement. But if that does not happen, and then after price breaks below this low, it immediately goes back into the level, then this is obviously a fake out. Okay? And the liquidity might have been swept already. And so when you take a trade after you spot this fake out, your stop loss being below the level, because the manipulation has already happened, and then you try to ride the move. This is how some traders use this to their advantage. So to make a quick recap so that you'd really understand what we just talked about, most retail traders, what they would do is when price reaches a resistance level, which is prominent on the chart, or a support level, which is prominent on the chart, instead of them to just, jump into the market and trade because price is at resistance, they wait. They wait for price to because they know that if they could take a trade here and they could take a trade here, and then the smart money could just fake them out, and then the real move is going to begin. So what they would want to do is, more often than not, they would wait. When they see price getting rejected at resistance, they wait. Price struggling to break below above resistance, they wait until price breaks above the level. And if it immediately after it breaks, it fails to continue moving to the upside, and then it comes back below the level, they know that is a fake out, and that is the footprint of the smart money. And so they will take the trade with their stop loss above the level, and then they'll try to join the move. Okay? So how do you use this to your advantage aside from this? Or does this mean that if you're using this method and trading with the smart money, that every single trade you spot using this concept is going to be 100%? Of course not. And that's why I tell you that in trading, risk management is key. Because regardless of the trading methodology you're going to use, you're not going to be right 100% of the time. And you don't even need to be right 100% of the time. Most of the strategies that I use to squeeze profits out of the market, most of them are not profitable even 50% of the time. I'm only right like 40-something% of the time. And that is more than enough for me to become a consistently profitable trader. The reason behind this is because I make sure my risk management is on point. And how can you do the same? The way you can do the same is by making sure that your risk is consistent. If you're risking 1% of your trading account capital on each trade you take, make sure that after taking losses in a row, you do not get emotional and then trying to recover that loss, go from risking 1% per trade to risking 5% per trade, because you feel that this particular trade you're taking now, if it wins, is going to recover all of the losses that you had. Because no trade is guaranteed. And so when you do something like that, more often than not, it's going to dig you into a deeper hole, because if you lose that trade, let's say you were risking 1% and you lost 5 trades in a row, and now you're angry. And you want to make back all of the money that you lost on a single trade, because you just don't have the patience to wait for, the markets to give you winning trades. And so you risk 5% of your account capital on a single trade, aiming to make a profit of 5% on that trade, or 10%, 1:2. But then it so happens that the market decides, you know what, I'm still not going to give you a winning trade yet. And so that trade that you risked 5% on turns out to be a losing trade. Guess what just happened? You now are down minus 10%, instead of you being just down minus 6% if you had stuck to your risk management. And being down minus 6% is nothing, because if you're trading with the 1:3 risk to reward ratio, for example, it could so happen that you were risking 1% of your account capital on each trade you took, and so you took 6 losing trades in a row. But if you just get 2 winning trades in a row, because you're risking 1 to make 3. Remember, the risk to reward ratio is 1:3. If you just get 2 winning trades in a row, those 2 winning trades would pay for all those 6 losing trades that you had before. And so if you don't trade with proper risk management, meaning you keep your risk consistent, whether you went through a winning streak, you don't get greedy, or whether you went through a losing streak, you don't get emotional and revenge trade. You keep your risk consistent. If it's 1%, it's 1%. The only time you decide to, maybe increase your risk a little bit or decrease it is when you're doing it systematically with advanced risk management concepts like, what do you call it? Dynamic risk management. Okay. But that's a subject for another day. For things to just be simple, you keep your risk consistent and you aim for a risk to reward ratio of like 1:2, positive risk to reward ratio, meaning you're risking 1 to make 2, or you're risking 1 to make 3. Okay. But I want you to bear in mind that there's a relationship between your strategy's win rate and its risk to reward ratio. So what does that mean? Most times, what you'd find that if you're trading with a trading strategy, for example, that has a win rate, which is in, a modest win rate, something like 50%, 60%, most of the times you're going to be able to get those type of win rates if you're not aiming for very high risk to reward ratios. So if you're aiming for risk to reward ratios like 1:5 or 1:6, it's not uncommon for you to have very, very low win rates. On the flip side, if you're trading with a strategy that has a negative risk to reward ratio, for example, there are traders who use trading strategies that they will be risking, for example, 1% of their trading account capital on each trade they take, but they're aiming for a profit of 0.5%. So this is known as a negative risk to reward ratio. This can also work. It's not like it's a one size fits all, that whenever you risk 1%, you have to aim for 2 or 3% or whatever. No, it's not a one size fits all. Most times there are traders who are scalpers, or day traders who they risk more than they aim for. But for that math to work, then their win rate needs to be very high. If you'd be risking 1% and aiming to make a profit of just half of what you are risking, then if you have a win rate which is less than like 80 or 70%, you're not going to be making money. Even though on paper it will look like, okay, you have a very high win rate, you're still going to be struggling to make money, because now your average profit is smaller than your average loss. And so over time, your losses are going to eat away your profits. So for that kind of strategy to work, you need to have win rates that are in the 90%, for example. If you're risking 1% and you're aiming to make a profit of 0.5%, then you at least need a win rate of like 90% or 95% for it to work. So me personally, I prefer to trade with a positive risk to reward ratio, meaning when I'm risking 1, I'm aiming to make more than that 1 that I'm risking. The reason is because it gives me room for error. So when I take a trade and it doesn't work out, even if I lose more trades than I win, it doesn't really matter, because at the end of the day, my wins are much bigger than my losses, and so they will compensate for that and give me profit in the end. But if you're trading with a negative risk to reward ratio, then you're going to be pressured on having to be right. Because if your win rate is just off by a little bit, you're not going to be profitable at all. And so since I know that in the market, I can't be certain that whichever trade I take is going to be a winning trade, I prefer to, have a negative risk to reward ratio, so that even if my win rate is very low, I would still, at the end of the day, end up making money. Okay? And so this is just the math behind it. Manipulation is just a concept that happens in the markets because of the liquidity issues that these large traders face, the institutions, okay? You and I, retail traders, small retail traders, can get into a trade by just clicking on a button, because we are trading with relatively small amounts of capital. But these guys are trading the big bucks. They're the smart money. And so they can't just click on a button and get into the market because of the sheer volume that they're trading with. And so most times when we place trades and we place our stop loss, they look for areas where retail traders are clustering their stop losses. And so they'll try to push prices up, take out those retail traders, because it's when their stop losses get hit that those, what do you call them? Those smart money, their orders to get into the trade is going to get filled. And so when they trigger those stop losses and get their trades filled, then the big move is going to begin, because they are the ones who cause the big moves in the market more often than not. And so that's just what liquidity sweep is. But I didn't just tell you about this because it on itself is not going to make you profitable. You have to couple it with proper risk management and having the right mindset. So if you encounter a couple of losing trades, you continue going, okay? You don't change anything. And if you encounter a couple of winning trades, you don't get greedy and change your strategy or start, doubling your bets or betting the farm or all of that. You need all these three things to be in place. Your strategy has to give you an edge over the market, your risk management has to be on point, and your trading strategy has to be on point as well. Okay? And so before we wrap up the class, I would like to use this opportunity to introduce you once again to the suite of bots which are offered by the ITU global community. Okay? These are robots or expert advisors which are designed to help you trade on your behalf. So they would identify low risk, high probability trading opportunities for you, and then they would do the proper risk management and everything, place those trades on your behalf, and help you to start earning while you're learning, okay? So you can diversify a portion of your portfolio to this bot so that they will trade for you and get you earning while you're learning. If you're interested, please reach out to us in this comment section or any of our social handles, and we'd be more than happy to assist you set everything up in a step-by-step manner. Once again, thank you very much for taking time out of your busy schedules and making it to this class. I look forward to seeing you guys in next week's edition. Have a wonderful rest of your day, and God bless you all. Cheers.